open. Okay, hello. Welcome to this week's episode of 10,000 Startups, Legal Strategies for Startup Success, where every week we interview and talk to somebody who's very important in the startup world, especially some of the legal issues. And this week, we're actually talking to a real live venture capitalist. Andrew Romans is a VC. He's with 7BC Venture Capital. He's a 3 times published author, a university professor, and a host of the podcast Fireside with a VC. And we're going to talk about some of the terms of a venture financing. So thanks, Andrew, for agreeing to do this.
Oh, Roger, great to see you. Thanks for having me.
Yeah, so let's just kind of jump right into it. So our audience, as you know, is mostly startup founders and also a lot of service providers, and they're going to be looking for term sheets. And once they get one, they're going to want to know what to focus on. And I guess the very first question everybody asks, everybody kind of just zeroes in on valuation. So can you tell our audience, when you're making an investment in a company, number one, how important is the valuation? How do you determine the valuation? And does any of the rest of the stuff matter once you figure that number out?
Yeah. I mean, it's such a great topic, and I think that it's meaningful topic for angel investors, venture capitalists, limited partners, the entire M&A advisors, just everybody. So this is a pretty important topic. And you kind of have discounted cash flows and comps in the publicly traded equities world, which anybody with an Excel spreadsheet should be able to figure that out, where what's happening in Silicon Valley is a little more, it's a mix of art and science, not purely science for how you do valuations. Also, you've got the continuum spectrum of, pre-product, pre-revenue, company has not been formed yet. It's one person with an idea or 3 people with an idea. How are you supposed to value that? Up to now the team is formed, they've raised a bit of money, you're getting into their first outside cash financing, which might be friends and family, so all the way up to Series A, Series B, Series C. So I think that let's start with, how do you value a company that is pre-revenue and pre-product? Typically what you can expect to happen in an evolved ecosystem, or even, you and I both travel quite a bit, and it feels like Silicon Valley everywhere I go, from Kuala Lumpur to, Australia. It's kind of the same thing everywhere. So I think what you can expect to do is raise your first kind of 250 to 500K. And of course, everyone's going to be born differently. Some people just sold a company or have a huge service provider that, does accounting for people, and now they're trying to make a spin out accounting software company. So they might be able to fund their business with other revenue streams. But let's just talk about the teams that need outside funding. You probably want to raise, as a general rule, you want to make your earliest financing attractive so that it's a good deal to a professional angel or seed stage venture capitalist. But you don't want to take too much dilution, that there's too much dead weight in the cap table, that you don't have enough capital to attract future financing, where later stage VCs are going to have their ownership target percentages of what they want to own. And you also want to have enough equity in the business that you've not sold to investors to retain and attract talent to work at the company. So, key hires, employee stock option pool, and that kind of stuff. So in the ancient times, people basically used to say, like, if you talk to the band of angels going back into like the early 90s, a company that's just two people in a garage or 5 people in a garage starts off being worth $1 million, and they raise like 100 grand or 250 grand. That's really changed. I think that pre-money, and these tend to be safes and convertible notes when you're raising a very small amount of money, which we could talk to you about in a minute. But purely staying on the valuation topic, I think that if you raise a first 250K to 500K, it's probably coming in on a convertible note or a safe. So you don't have any legal expenses with that. You don't want a high percentage of your financing going to pay the lawyers if you can push that, kick that can down a bit. but you're probably looking at anywhere from 3 million to $5 million valuations. If the team has already founded a company that raised venture capital funding and they had maybe even a bad outcome or a good outcome, you probably expect that seed valuation to be somewhere in the range of $5 to $10 million. And just like the stock market went up like crazy in 2021 and startup valuations, really went up. The stock market crashes and there's a little bit of a lag before the startups kind of get the memo that they should lower their valuations as well. But we've now seen about a 50% reduction in the valuation of a raw seed deal. And even like the YC, like Y Combinator, which has always got typically higher valuations for that same seed stage, their valuations are down by about 50% from where they were.
So is that your rule of thumb? You just look at how early it is, and they all fit in kind of this general category. I think our founders would like to believe it's more scientific than that. That there's some metric.
Well, I mean, there's a lot of things to measure when the company has a product and it has some customers. It's managed to get its first customers. And we can get, and I want to talk about that, but if you just look at the pre-product, pre-revenue company, you're really focusing in on the founder and the team, because most startups are going to pivot. And so pivots are almost inevitable. They try something and they, like Brex started out, I forget what it was, but it was like, you couldn't be more opposite than what they ended up doing, pivoting into. And so you're really left in a world of pivots. You're left with a management team, and hopefully they stay within the same sector that they have experience and knowledge from. Like if these were real estate people, like I heard a company pitch me the other day that was kind of Uber for X for personal trainers. And the team, one of the founders was a personal trainer, and now he's kind of an MBA guy. And so he's thinking, I'm going to do Uber for X for personal trainers. And then they've added some other elements that make it, more interesting than that. But if that company pivots, he's probably still going to be in that sector. Another thing that you look for, so you're really, if real estate is location as the most four important things, I think in early stage pre-revenue investing, and even throughout the spectrum, it's management, market, technology, in that order. So you're really focused on management. Then you're looking for a big market where there's potential for this to become a multi-billion-dollar company with power law venture returns. And then there's got to be technology, or else people like me, are not even going to talk to you. We want to see some, we're at a point in history where we can automate human workflows and leverage data, kind of a la AI stuff. If you're not doing that now, we're probably not interested, in investing in that. But another thing is, when you say you're looking for some more science, if you look at Skype, Nicholas Enstrom, Jonas Fritz, who founded that company, that was founded at a time when everybody who knew anything about telecom had a software switch running on their laptop that enabled them to email somebody to download a soft client, and we could have free on-net calls with or without video. There was nothing unique about that, okay? They had a good voice codec from Global IP Sound, who I also know, but this is what they had that would have made it a very valuable pre-product, pre-revenue company. They had created a copycat of Napster. So they're in Stockholm. Napster is Silicon Valley. They made a copycat of Napster where people can get free, basically steal their music and their movies and other stuff and software. And they had 11 million unique views per day going to Kazaa, which was their Napster copycat. And these people are unlimited broadband, tariffs, which was not a given at the time, comfortable with peer-to-peer technology. You couldn't have had a better group of 11 million daily active users. And they just advertised Skype on their own thing saying, hey, you don't pay for your music. Why pay for telecom? And so it was very credible. You could, if they had pitched that to me, I would say, what's your magic secret distribution channel? Like I once met the founders of Match.com, or let's just forget it was Match.com. Like every dating website starts with somebody stealing a database of women. That's how they are all born. And if you just say, my plan for the next dating website is to raise money from you and spend money on ads on Facebook, buddy, you got to be a little more imaginative than that, right? So at the early stage, you're looking a lot around team and building an advisory board. If you're really trying to make something out of nothing, and it's like 3 young people or 2 young people trying to digitize an industry that they come from, it's not a bad idea to maybe offer 3 to 5% of the company to an advisory board if you're not from Silicon Valley and you kind of don't know anybody, and just kind of gift them a little bit of equity. And then maybe say, look, if I can say you're a cash investor, let's do an advisory round and get you in. So I can say that you're an investor and open some doors and, just look a lot more credible. So you see kind of some young guys going after a big industry, and they've got like the vice chairman of CBRE San Francisco is an advisor to the company, like Dan Harvey, who
that'll help their valuation.
That'll all of a sudden change everything. Like Dan Harvey, if he becomes your real estate super expert, he's an LP in our fund. Like, you get a guy like that on your advisory board, and I have to take the meeting.
Yeah.
It's like if your sister asks you for a favor, you have to do it, So that could be, a way of differentiating. But let me just answer your question on, do we care about valuation? We do and we don't. I probably should be shot for saying we don't, but we're ultimately looking at, what is this company going to exit for? And with experience, there's going to be at least 50% dilution, right? So if I'm invested in a company at a $10 million pre-money valuation and it sells for 100 million, that sounds like I'm going to make a 10x return, right? So if I put $1 million in, I should get like 10 million back. Invested 10 million and exit at 100. But you're the guy who explains the denominator and the math to some touristy investor who's like, what? And the founder is like, what? Everyone's unhappy, because they haven't figured out the math yet. So, you're looking at kind of minimum 50% dilution from your entry point. So if you get in at 10 and you get out at 100, you're not making a 10x, you're making more like a 5x. And not to mention all the, wrinkles and hair loss you're going to have from getting older, waiting for this to actually materialize.
Okay.
So yeah.
And you're kind of backing into the valuation based on where you think it would exit.
And I think this is an important thing to do. And I know I'm speaking too much here, but if you're investing really early stage, you are shooting for a big multiple. So if you back your way in from that exit point dollar number, like the company is sold for $1 billion and I'm investing at this valuation, they expect and need a very big multiple because they're going to have a high death rate. A big percentage of these companies will run out of money and disappear. And so those that survive, you talk to Ron Conway, he's in Google, he's in Facebook, he's in Groupon. It was every IPO that ever happened after the dot-com crash. He was in them all. And yet the high death rate brought the actual cash on cash return down. If you're investing as the last money before an IPO and you don't get jammed of investing your money at the height of the bubble and then it crashes on you, in general, in normal times, the late stage investor can have a more concentrated portfolio of, it doesn't need to be as diversified to neutralize the risk of anybody going bust. They maybe are kind of like senior liquidation preferences, so they get their money out before the early guys like me get our money out. They're not looking for a 54x, and no one's giving you a 54x when you're investing in Stripe. They're kind of shooting for a 2x to 4x on what they're doing, depending on how quick it is and how safe it feels, And those guys are often commanding like huge multi-billion-dollar funds. So if they can 2x a $1 billion fund and raise a new one every 2 or 3 years, that's 200 million of carry for the VC.
Right. So we're going to do a whole session on venture capital economics, but let's move on. Let's shift gears here for a little bit. So part of it is the economics of what you expect as a VC, But I've always heard that the reason you take venture capital money is not just for the money. You're taking really smart money. You're taking money that's going to give you really good advice on how to run your company. They might have some later investors for follow-on rounds. They might have relationships with investment bankers, etc. So let's talk about the control side of this. Do you usually take a board seat? And what does that mean?
Yeah. So they're basically in the actual priced round financing, and to some extent synthetically recreating that in a convertible note or a safe note. But let's just talk about a typical priced equity financing. You've got the economics side, like what's the valuation, what's the liquidation preference, stuff like that. And then you have the governance side of things, of who, how many board seats, who has control of the board. And on boards, you want to have an odd number. And I like small boards. I think you can start small and let it get bigger as it gets out of control. But you want to have like a board of 3 people. So you might have 2 founders on it, and then 1 investor might take a board seat. And you really don't want to be on the board of directors if the company is so early stage that they haven't been paying for director and officer insurance, D&O insurance. And so you might have an advisory board where they're not liable to get sued from a company that's unprotected without insurance. But by the time you get to like a late seed or Series A, you typically have the VCs want to take 2 board seats. The founders, including the CEO, get 2 board seats. And you typically see a 5th board member that's a non-executive director or a NED that is the mutually agreed to board member. So 2 founders each get a seat, and 2 seats go to the VC that's leading the round for now. And then it's written in the document, that you probably have the boilerplates for it. It says a mutually agreed to board member. And we actually have such a diverse set of LPs ourselves that we like to get that mutually agreed to board member every time. So it's like a secret that's not that well known, and I'm saying it on a podcast, but we have just got so many amazing LPs. Like part of the problem is, like, I was just talking to the guy who's in charge of Copilot at Microsoft. So like the engineering AI that helps you check your code and synthetically rapidly develop products and stuff. And we were talking about what Microsoft is allowing him to do. For example, Microsoft would not let him talk about AI on my podcast or your podcast. But I think it's good to get, if you're a founder, my advice to a founder is try to be the person that recruited that mutually agreed to board member. Show the VCs that you have domain expertise. If this is a real estate construction deal or whatever, that you're getting like a guy out of Clark Enterprises that's one of your customers, let him take the board seat. The VCs go, oh, he's serious people. Because part of what's happening is that guy's probably more loyal to whoever brought him in.
Yeah.
And things don't, when things get rough, having control of your board is not a bad thing.
Right. Yeah. Good advice. And at an early stage, you're saying you only need 1 seat out of 3, maybe. And then we'll have somebody you trust as that mutually agreeable 3rd member. But still, you're not in control of the board at that stage, right?
Well, I think that's the most common thing. I mean, people, you hear people say, oh, I want to have the same terms that Mark Zuckerberg had. It's like, well, why don't you launch a company that overnight takes all of Harvard, adoption and grows like a wildfire spreading across Texas and California? Then you could talk to us about that. The one thing that, probably we should just mention a little bit here is that sometimes the founder thinks, I've got control of the board of directors. I've got like Uncle Luigi as the mutually agreed to guy. And it's me and my former roommate from Stanford. So we have control of the board. But there's some little details that are, rights and privileges that go to preferred shareholders.
Yeah,
right?
let's talk about that. That's the protective provisions. And I see founders kind of choke on that frequently when they get that term sheet and they say, gee, look at this veto right they've got. There's all these things. Can you tell us a little bit about that and why that's important?
Yeah, and you know, I really have the compassion and memory of what it was like to be a founder who never had any idea what redemption was or blocking rights. And I remember the first time I got a term sheet from Steve Norris, who's a co-founder of the Carlyle Group. And I read the terms, like I was, you know, staying up late and reading everything. And I was like, can you explain what redemption means and why is it there? Like at any minute, you can just ask me to return the $15 million. That would obviously be a death blow to the company. So you're just walking around with like a dynamite stick. You can blow us up with at any time. And like when I saw liquidation preferences, I was like, this is getting worse with each sentence I read. And so my reaction was, this is horrible. But like, you know, a basic thing of like liquidation preferences is that when the company is liquidated, and hopefully that's a positive outcome for everybody, that if the company is sold at a much higher valuation than the entry point.
Yeah, can you define liquidation? Because it's different than what it sounds like.
Right. Liquidation sounds like, you know, Sherwood is shown up with their death, you know, thing in their death outfit, and they're doing like administration for the benefit of the creditor, ABC. That's like the worst, right? But liquidation could just mean that the stock is now liquid and it's freely traded on the NASDAQ, or we went public on the New York Stock Exchange and we've survived a lockup. You know, now in the case of an IPO, all these horrible terms that sound bad to the founder, which you probably should accept almost all of them, your preferred shares and different classes of shares and the common founder shares all get converted to one class of shares. And so it's even worth knowing this. If you truly are on an IPO path, don't be blowing up your valuation over terms that are going to get erased when you have that conversion, right?
Yeah. Of course, most companies, it's an M&A exit.
That's right. So the IPO window opens and closes, and it, you know, the big boy exchanges don't open the window for very many. So the most common mathematical, statistical, positive outcome for any startup that raises money from angels and VCs is a mergers and acquisitions sale of the business. And in those cases, that's a liquidation of the business. That congratulations, you've sold your company to Amazon, Microsoft, or Google. Mm-hmm. And the liquidation preference means upon that liquidation, the preferred shareholders have a preference. They get their money out first. And there's kind of two different types of liquidation preferences. There's participating preferred and there's non-participating. So basically, the more you're fluent as a founder in all this stuff, the more fundable you are. And if you're fighting over something like that's against your own interest, it doesn't make you look like a really fundable founder. One of the criteria that we look for in a founder, and sometimes we have to manufacture it, is that, oh my God, this woman is so great. She can raise money like a machine. And she knows all the terms. She totally understands the nuances. She'll have no trouble raising money. So when it's time to raise money, we can get it done quickly with good terms and good investors. If the founder really doesn't know any of this stuff, you're like, how much free bandwidth have I got to explain all these things to her or him and, you know, try to coach them along? So this is important stuff. So participating preferred is that, so first of all, the idea is that if we put $1 million into a company and we own like 1/3 of the business, we don't want those founders to turn around and sell the company for $500,000 and take 2/3 of that money. Okay, that would be a bad thing for the investor. So if we invest $1 million and we negotiate a liquidation preference, we say, upon the sale of the business, we don't just get 1/3 of that $500K, we get our $1 million back, either most typically one time. So a 1x liquidation preference means the investor gets her or his money back 1x. I've lived through enough that I've seen a toxic liquidation preference, which is a way of, you know, it's like chemical weapons before what I call nuclear weapons is put the company to administration and buy it back for $1. That's nuclear. Chemical weapons is put in a toxic liquidation preference so that all these investments have happened and someone says, we're putting in a liquidation preference of 50x. which is basically a pay to play that's wiping everybody out. But the normal liquidation preference is a 1x. And sometimes you do see a company is running out of money and they have like an acquisition offer on the table. And if they don't just get a little bit of gasoline in the tank, the car is going to explode and the acquisition won't happen. Or there's a major customer event, or there is it's just looking bad. And they're saying, we're trying to raise money and nobody wants to invest in the company now that things are not going well. And someone comes along and says, I'm offering to put enough money to get you through the year, and I want a 5x liquidation preference. So I'm just putting in $1 million, and when the company is sold, I'll get the first 5 million back, 5x that 1 million. And the founder says, oh, I believe that with this $1 million, we can sell the company for 100 million. And the VC says, well, I'm pretty sure you can sell this company for like $1 million. And if I know I get my money out before everybody else, I'm feeling comfortable enough to wire this money knowing I'm not going to lose money, or believing I'm not going to lose. But the most common thing is a 1x liquidation preference. And then you want to know the difference between participating preferred and non-participating. Non-participating, and I get a little dyslexic with this sometimes, so correct me if God help me if I'm saying the wrong thing here, but non-participating means that, all right, here's $1 million. I've bought 10%, 20% of the company, and I get my money back 1x as a liquidation preference, and it's non-participating. So if the company is sold for whatever amount, I, as the investor, have the choice of either getting my money back 1x and I walk away, or I waive my liquidation preference and I get 20% of the exit consideration because I own 20% of the company. Participating preferred liquidation preference means, which is the way I grew up in the old days, it wasn't as founder friendly back then.
I remember that.
I remember, like, I never even heard of non-participating for a long time. That before the .com meltdown, you had participating preferred, which means I get my money back 1x or maybe 2x. 1x was not a given back then. And so you get your money back 1x or 1.5 or whatever it said in the document that we all signed. And then after I get my preference out, then I get my 20% if I own 20%.
Yep, that's participation. These days, it's been a long time since I've seen anything other than 1x non-participating. That just seems to be every deal. I mean, but you're right. 20 years ago, everything, it was always participating with a cap, right? So you participate, you get your money back, and then you participate and you get a multiple of your money back until you've reached 3 times your money or something like that. So it's way more complicated. But now it's, I think, wouldn't you say that people are kind of betting on that percentage? They're betting they're going to convert and take their percentage, right?
Yeah, I think that there's a little bit of like animal instincts relationship and discussion where you say to the founder, like, hey, listen, why are you so worried the company is going to be sold for less than $50 million? I mean, how unconfident are you about this business? Listen, man, I'm going to put in $5 million. I get my $5 million back, and then let me have my 20% ownership, because this is going to be a multi-trillion-dollar company. Didn't you say that? A multi-trillion-dollar company? So how can you be pitching me a multi-trillion-dollar company and now you're trying to protect yourself in an event where it's so bad? So that was kind of the environment. I think back then you didn't have as many VCs. And so venture capital is a services business, and there's a lot of competition. So there's VCs that what the name of the VC fund is practically founderfriendly.vc, So we've had a thing. Maybe, but I want to move on to anything you want to talk about, Roger, but maybe now would be the time to talk about dividends.
Okay, right? Sure.
Because dividends,
what's that? I haven't seen a dividend in 20 years, I think.
Yeah, so dividends is like a backdoor way of lifting the liquidation preference, where I kind of think of like dividends like the interest rate in a convertible note. So a dividend is not the company paying part of their retained earning or part of the profit for that year out to shareholders. It's not that at all. So it shouldn't even be called dividends because that's confusing. But what dividends means is that if an investor puts in, for simple math, $100 into the investment and the dividend says 8%, that means after 1 year, and let's say the VC has a 1x liquidation preference, participating preferred, so they get their $100 back, and then everything that's left after that, it's pari passu, who owns what percentage, right? The dividend gets measured annually, that if it took 1 year for the company to get sold, or if the company is sold in under a year, then I get my $100 back, and then it's pari passu. Everyone gets their ownership percentage of the exit consideration. After 1 year, if the dividend is 8%, now I get $108 back. And that's usually compounding. So it puts a little bit of it lights a little bit of a fuse under the butt of the founders to say, hey, don't think this is a lifestyle business. I've got a fund that I got to wind up after 12 years, maybe even longer. We want to encourage you to eventually get this to an IPO or an M&A outcome, because every year that you wait, the liquidation stack gets a little higher for you to get it out from underneath.
Yeah. So in other words, in your deals, you tend to accumulate that dividend every year. Is that right?
Well, like you said, if we start negotiating for dividends, the founder's going to say, "What is this? This is getting a little violent. I don't like it." The funny thing is that with the convertible notes, a convertible note has a cap, a discount rate, and an interest rate. Yeah. And there's some other stuff in there, but I don't want to derail this episode. But I remember it was an Israeli company, the first time I heard of an interest rate on a convertible note. And he was saying, so if we end up getting sold right away, and he's one of these guys saying, invest now, I already have M&A offers, right? Which I never fall for. He goes, if we get sold right away, then you get your money back either at the cap, or you get your money back, so you're safe on the convertible note. But if this drags on for longer and longer and longer, you should be rewarded for being in the deal earlier than these next investors. Mm-hmm. And so if you do $100 investment, for simple math, that after a year, if the interest rate is 6%, it's your $100 of debt will convert to buying equity at the cap or discount rate to the next pre. But if it goes on for a year, it'll be $106 convert in debt. So there's interest accruing. Right. So there's kind of like an incentive for the founder to not mess around and turn this into a lifestyle business that just pays for his 10 kids to go to private school.
It'd be expensive money at that point. And of course, a lot of private equity deals are done with cumulative dividends. The way I always draft it on the company side, if I can, is when, as, and if declared, which means never. And it doesn't accumulate at all. But that's one of those economic terms to watch out for. Is there anything else that's important to you in a deal when you go talk to a company that we want to call out? Management or
well, first of all, I think that it's good. Like I'm quoting you back to yourself here, Roger. It's good to be innovative and be disruptive in the technology space, except for when it comes to your legals. That when you're doing your own legals for your own Series A financing, try to go as industry standard as possible. And that's why I introduce founders to guys like you that I know have been doing this for decades. And is it, thick lapels or thin lapels? What's in fashion? You would know because you're doing more deals than I'm doing. So you can just tell the founder, look, a liquidation preference is non-participating liquidation preference. It's not a bad thing. It makes it easier for the VC to even raise money for their fund. Just take it, and we're not shooting for a subpar base hit. We're shooting for a home run. Mm-hmm. And so I like standard terms is basically it. So I I like to know the name of the lawyer representing the company, and then I feel good immediately. Of course, I'll read everything, but if I've never seen the name, if I don't know the name of the lawyer, I'm like, oh, who is this? Because I like standard terms. But another thing to think about is that you have like voting rights of a board of directors. And, we even recently experienced like some strange voting things were happening, and the safe holders had no votes. it was only the equity priced around people that got to vote. And there was a substantial amount of safe, investment in that thing. But is like blocking rights. Sometimes as a founder, you should really understand, even if the VCs do not have a majority control of the share capital and the board of directors, they might have the right to block a sale of the company. They might have the right to block a financing of the company, and there might be drag along rights that drags along other people's vote to do what they want them to do. So all of this means that when you're raising money from a VC, if your stomach is telling you that you don't like this person, that person might be able to feel that, and they know you don't like them. And this is like a marriage that you cannot get out of as easily as go to divorce court, right? So you really want to get a good vibe on saying, what are the economics of this term sheet? What is the reputation of the venture capital firm that's investing in my startup? And what is my chemistry with the lead partner? And is that partner really going to be there in 5 years? Because this thing might take 10 years. And it's a long-term marriage. And you shouldn't just lightly marriage people based on dilution only.
How long is the typical exit, start to exit? I know your fund lasts around 10 years, I'm guessing. Do you expect to exit within that amount of time?
Yeah. So, and this is something that I've tried to keep my finger on the pulse of. What is the time delay between seed and exit? What is the time delay between Series A and exit? And in my, short lifespan, the time delay between Series A and IPO in the late 90s was like hours, right? And so that was like unusual. You invest in a company at IPOs, it's loss making, it has no revenue model yet, but it's worth $1 billion, right? And then we had the dark days of the dot-com crash. The point is, it fluctuates. I think that with the Putin invasion of Ukraine and the crash of the stock market, people are not so excited about exiting if the multiple of the market cap of the publicly traded guys that are the consolidators that buy you is much lower than it was, 2 years ago. They're thinking, why don't we wait for better days before we exit out of this, And so there's compression on valuations there. So I would say, when you thought you were only X number of years, you could just kind of tack on 2 or 3 years. And also, if you think about it, we hit lockdowns in March, April of 2020. So anyone that was kind of ready to exit, it was unlikely that it was going to happen there. The exits that were happening there were people that were in dire straits, right? So the good exits weren't. The power law, return my whole fund exits were kind of canceled for 2020. And then 2021, everyone was like, hey, everybody is buying their stuff online. Now they're in lockdown. So valuations, money was free. And so people were raising funding at super high valuations rather than exit. In hindsight, we should have all been exiting in the spring and summer of 2021. But out of greed, we all raised money at multi-billion-dollar valuations for our little startups. And then 2022 was an invasion of Ukraine. In 2023, it's still 2022. So basically, that's like 3 years of no exits. And that's why it's driving people to get mature about selling some shares on the secondary market while they're still private to, return some capital. But I think that the time delay between Series A and exit, fluctuates between like 2 to 7 years. And if things go IPO, they take longer. In a fund, you tend to get some
time. I mean, what you said, people want to exit, they want to take some cash off the table. How do you feel about that as an investor? Your founder is pulling money out of the company.
It's very much on a case-by-case basis. So, I had the experience of being worth 300 million on paper, and then it went to zero for one of my startups. And you could guess the year that all went down, right? So I have some compassion for the founder. And also, founders don't want to raise capital and pay themselves too rich a salary. That's kind of often gets red flagged. People just want you to suffer until the afterlife is basically the model here. It's like being a serf in medieval Europe. There's a heaven, and that's when you'll get paid. So suffer now, right? So I have some compassion for it, but what I really do not like is when a pre-revenue company or pre-product company has some whiz-bang amazing founding team of like 7 heroes, and they're trying to raise a large round from a corporate, and then they have a big secondary built into that. It's like, yeah, you better be shopping that to corporate venture capital firms that don't care, because a financial investor wouldn't do that. On the other hand, if I see that the company has been growing value for a long time, and they've built a very valuable business, and they're going for the long term, like they're going for a 7, 10, 12-year horizon as their entrepreneurial journey. And if people are investing in the company at a $500 million pre-money valuation, why not just sell a little bit of founder stock and even try to legally make it preferred for the investor so it's attractive, and that founder can stop her husband or wife from leaving them. They can keep the family together. They can avoid, mental illness problems. They can sort out their mother who's needs a house and has every disease known to man. I mean, in life, sometimes you need a little bit of money, and especially if the VCs have blocking rights. And like, here's a classic. Zohar Levkovitz was the founder of Amobi, I think, an Israeli guy. And, AdMob got acquired by Google for like 850 million. And Yahoo was still in the game. And so Yahoo offered him 300 million. He wanted to take it. Sequoia gave him 15 million secondary of cash, some liquidity, to go along with rejecting Yahoo and fight for a bigger $1 billion exit to truly return Sequoia's fund. Mm-hmm. So Sequoia was basically saying, we're not letting you sell at 300, even though for him, he owned like 26% of the company. I know this because of the Founders Club. And
I'm hoping this is public knowledge.
Yes. Well, I mean, I think it is. I mean, Singtel bought the company for $306 million, like 4 or 5 years later. So in hindsight, they should have just sold for 300 to Yahoo, Mm-hmm. But so in some cases, a secondary makes perfect sense to me, and it solves problems within a family that are real, that are running these businesses. On the other hand, I've seen some of our portfolio CEOs take big secondaries, like 35 million. Yeah. And then all of a sudden I'm like, oh, she's never going to sell this business. Yeah. Like she likes being CEO, and you've got to make an offer that she can't refuse to ever get us liquid. And so when we were talking about what is the time delay between entry point for an investor and exit for the investor, if you see the founder taking $30 million, I promise you the time delay got bigger. Yeah. And in fact, if they're taking liquidity, then I'm all for we should take some liquidity too, because the final finish line end zone just got further off.
Gotcha. Yeah. Okay. Well, I want to be respectful of your time. Is there anything else that you want to tell our listeners before we wrap up here about
I would say, I would say that founders seem to be born coming out of their mommy's womb screaming about dilution, and that's the only thing that they care about. And as they go through life, you may find that giving the VC blocking rights and all these things should be paid attention to. Was it participating? Was it non-participating? So all these things matter. And so I think it's important to have someone in the orbit of the company that is like a super experienced angel investor, or former VC who now just likes doing angel investing, or someone like yourself, like a Roger Royce, that really knows these things and even follows the market of like, hey, that was normal in the 90s, but this weird VC from Miami that no one's ever heard of, they're asking for an arm and a leg and a rib in your legs. That's too much. And so it's important for the startup to have counsel from a lawyer. It's not the law firm you don't need, it's the partner you need that knows this stuff in and out and can give you trustworthy advice that works for you, not working for the VC, that can guide you through it. And if you don't have that, just have somebody in the orbit of the company that really knows this stuff. I'm not going to name the accelerator, but I had a call this week or last week with a founder who told me that this very prestigious advisor mentor at the accelerator was advising him to raise a seed round on an uncapped note. And, so the more the investor helps the company, the less of the company that they own. And that's just bad advice. So, not everybody walking up and down University Avenue in Palo Alto is giving great advice.
Yeah, that's right. Well, that's a mistake every lawyer has made once in their career. You don't make it again.
Right. When you see the ultimate divvying up, when you see the turkey getting carved up on the day of exit, all these terms will start to take on a whole real meaning. When in the beginning, people were just looking at valuation, size of the round, dilution.
Right. Okay. Well, with that, I want to thank you for being here, Andrew. This is Roger Roy's 10,000 Startups podcast, as well as on YouTube. Make sure you subscribe and that you follow us and get a copy of my book, 10,000 Startups, Legal Strategies for Startup Success. We've been talking with Andrew Romans. He's a venture capitalist, a 3 times published author, university professor, and a host of his own podcast, Fireside with the VC. So Andrew, if one of our entrepreneurs wants to pitch to you or wants to find you or talk to you or disagree with you or whatever, how do they get a hold of you?
Well, if they want to disagree with me, I don't know, post something on YouTube or whatever. If they want to contact us about being part of what we're doing with investing or raising money from us, I'm easy to find. It's Andrew at 7bc.vc. And we could put it in the show notes. So Andrew at 7bc.vc.
Yeah, I'll drop that into the show notes. Okay, thanks very much.
Thank you.